Kitco Mining's special coverage of Mines and Money in Miami, Florida is brought to you by Gold Shore.
Hello and welcome to Kitco Mining with me, Paul Harris, here at the 2025 Mines and Money event in Miami, Florida. Now, they say knowledge is power, and my next guest helps provide one of the most important data sets in the industry. Joining me to tell me more is Kevin Murphy, Research Director for Metals and Mining at S&P Global Market Intelligence. Kevin, welcome to Kitco.
Hey, thank you very much. Glad to be here.
That's a very long title, so perhaps let's just start with a very brief summary of what S&P Global Market Intelligence is and what you do there.
Sure. So, S&P, we provide mining intelligence. So we provide data for everything from financings for the earliest stages of exploration through supply, demand, price forecasts for commodities, everything in between as well. So if you want to know about discovery rates, we've got that.
And you're independent, you're not necessarily tied to any one organization or...
Absolutely not.
Excellent. So hopefully we go down a few rabbit holes. Now let's start with the big picture. Where are we in the commodity cycle right now?
We're in a strange spot. I feel there's really been divergence in the commodities. So you've got copper and gold that are doing so well. Gold in particular, I think everybody should know that we're flirting with 3,000 an ounce. And then you have other commodities like nickel and zinc that are just they're languishing. There's a lot of headwinds on them. So typically when we look at these cycles, it's like everything goes up, everything goes down, everything goes up. Not this time. It's really success and failure. It's very interesting. So this is not a typical cycle at the very least.
How do you determine what part of the cycle we're in? What are the markers, if there are any markers?
Well, generally we determine it posthumously. We look back and we go, oh wow, that was the bottom. But it's all about market caps and metals prices and looking at that relationship. And we're definitely seeing very differing trends there because metals prices, as mentioned, they're diverged. And market caps, they're also not reflecting necessarily the value that's $2,900 per ounce of gold reflects, and that's definitely a theme here at Mines and Money this year for sure.
Oh, absolutely. Now let's break that down a little bit more if we can. S&P collects an awful lot of data. We're at a mining finance conference, so maybe let's start there. What trends do you see in the data in the mining financing for developers and explorers? Who's raising money? What kind of projects? What kind of metals?
Critical minerals have been pretty successful over the last couple of years. It's been, I think a lot of people who would be watching this will know that, if you're trying to finance a project right now, it's not the easiest. Financings in general are on a downtrend. And the ones that are getting financed have recently been a little bit more on the critical mineral space and a little bit more in that advanced project. So something that's in a feasibility level, not so much for the raw exploration.
Now, juniors find it increasingly difficult to raise money, I would say, and which obviously doesn't bode well for the mining sector in general or for humanity who want to consume all the minerals and metals that they discover. Why is it that it's so hard for juniors to finance today?
Oh, this could be the rabbit hole that you mentioned. So
it's one of the.
It's one of many. So it's a really long story, I would say, that sort of falls out of that last bull run that we had 2010, 2011, when the money was never going to stop. The good days were never going to end, and then of course they did, and they did so pretty cataclysmically for a lot of companies.
And for a long period of time.
And for an extremely long period of time. It was a very long downturn that we saw. And you have to think about how companies went into that downturn. Debt. I can remember back when I was a younger analyst covering the sphere, there was a lot of debt financings from that 2008 to 2011 period. You don't see a lot of that anymore. There's not a lot of debt going to juniors. In fact, I would say there's practically no debt going to juniors, which is something that actually existed before. So there was a lot of high debt load, and then all of a sudden commodity prices crashed and share values plummeted, and then companies were left with plummeting revenues, high debts, and that was not looked upon very well by shareholders, that's for sure. So we saw a definite turn away at that point from a lot of institutional investors. We lost a lot. Some of the people who you would expect to be investing now aren't. And this isn't just us saying this. We speak to all kinds of different entities like the TSX. And they agree that those traditional institutional investors, they're not around. And the ones, some are aging out, to put it gently, and we're not a cool industry for kids. So those millennials who are starting to take a larger and larger part of the investments, they grew up hearing that mining is a four-letter word. It's terrible, and that is unfortunately persisting. And maybe a little bit of that is the industry's fault. We've seen the social media, we've seen the TikToks against mining, and we've said nothing. We haven't tried to make ourselves look good. So it's a little bit of alienating the investors we had and not appealing to the investors we could have. So it's tough.
That's a tough spot to be in. A lot of people have spoken or reflected on the fact that the number of brokerages has reduced, the number of specialist funds has reduced, ETFs have taken out, investing in, humans investing in stocks. It's become more automated, if you like, or digitized. There's very structural things going on the investor side of things, but on the issuer side of things, there perhaps hasn't been a structural change. And where am I going with this? Are there too many companies chasing too little money?
Right now, absolutely. That's just a fact that there's thousands and thousands of mining hopefuls out there. And when we're talking about financings being a fraction of where they were a little over a decade ago, there's not enough money. There's too many hands trying to grab it. So does that mean we need more consolidation in the industry? Realistically, if we want to be a grown-up industry like oil and gas, who we're always compared to, there's so many more mining companies than there are oil and gas companies.
In the natural world, when there's an unsustainable population, it sounds like we're talking about an unsustainable population here. The answer is culling. How can that be undertaken?
Oh boy, I don't know. Some of that, some of this is natural. We see it all the time when we're in prolonged periods where you can't get fundraising for mining. Mining companies become something else. We see that before they might have transitioned over to cannabis. So back when that was the hot topic, they transition. They go. Junior companies aren't going to just necessarily vanish. They'll go to where they see opportunity. So some have already vanished and become crypto firms. It's the way it works in some regards. So it's a bit of a natural process, a natural selection, if you will.
Okay, you mentioned debt, Kevin. 15 years ago, companies were over-leveraged. A little bit of leverage is good and quite healthy. Where are we now, do you think? A lot of the big names have spent a lot of effort in recent years to improve their balance sheet, bring down their debt. Have they done enough? Are we in a good, healthy position now, or is there more work to be done?
Overall, I would say it's pretty healthy level of debt. A lot of the financings you see now are the really traditional. They're refinancing their debt, which is what you expect them to do. They're not really taking on more debt. They really, when the downturn happened, in 2012, they were given a pretty strong mandate by their shareholders that they had to do this, and by and large, they have.
Okay. Now, in terms of the lender side of things, there's been some high-profile traditional lenders to the space that are no longer lending to the mining space, maybe touching on some of the ESG things and mining not being cool aspects. Is this something that appears in the data? The amount of debt available for the sector is shrinking, and it's obviously other alternative finance mechanisms are coming up, such as streaming and royalty financing.
I'm actually a little bit surprised there's not more royalty and streamings happening. That is one of those interesting financing vehicles that companies can turn to. It's beneficial on both sides. But there is definitely a reduction in the amount of willingness to provide debt, especially to the smaller companies. Even if they have a revenue form, there's just far less interest in doing that for sure.
And is that because the lenders just see risk, and risk on top of that?
I wouldn't want to place any sort of thought process onto them. They hold their reasons to themselves, but we can only say that it's pretty much factual that there's less debt to be had.
Okay. Now, you mentioned that some metals, the prices are flying, including gold and copper, of course. As markets get frothier, that typically, or in the past at least, has ushered in an M&A phase or buying frenzy. That hasn't really happened yet, has it? Are we still too early in the cycle?
It's definitely not quite happened with base metals. A little bit with the gold. There were some of the very high-profile acquisitions over the last couple of years. So I wouldn't be surprised if we see a fair bit more. And in fact, we've seen some headhunting, if you want to say. Some overtures have been made by some of the larger companies to combine. It didn't go through. But that just says that there's interest not only in acquisitions, but in major acquisitions. And it makes a lot of sense where companies have reduced pipelines of projects. They're not spending as much on exploration, so they have to get their projects in their production from somewhere, and the easiest way to do it is to buy another company that has it.
You mentioned that in the last cycle, companies, you could argue, were too aggressive on M&A, overpaid for things, took on too much debt to do so. Will things be different this time in the current and ongoing M&A cycle?
I do think so. That doesn't mean that there's not going to be blockbuster acquisitions. I think there will be. But they're definitely not going to be at a fevered pitch. And it's definitely just an all-around different all-around, is the best way to put it. We're not approving those $4 billion mines either that were being financed on debt. And we're not doing those major acquisitions. So there's a lot of things that we aren't doing, which will allow for some of the larger acquisitions to happen. But capital restraint is definitely the name of the game, especially when we're in somewhat uncertain times, because I do believe that a lot of miners learned their lesson about punching too hard at perhaps a questionable period.
I mean, I'm going to put it to you, did they? I mean, is the caveat that, the discipline's there until it isn't?
I mean, that can always be the case, right? All it can take is a change at the top, and all of a sudden everything we've said is no longer true because somebody's come in and they have a very different aggressive strategy. But for the time being, I don't think we're going to see anything really, really terrifyingly shocking happen. Unless, of course, we see something absolutely incredible in the very top echelon, an interesting combination, which, that's one of those overtures that happened but never actually went through.
Well, that must be disappointing news to the shareholders of companies with projects that they're looking to be gobbled up by bigger companies. Okay, let's talk a little bit. We mentioned gold prices are riding high, copper prices are starting to ride higher as well. Let's talk about returns to shareholders, dividends. We are in the middle of 2024 financial results. A lot of the gold companies reported today as we're recording this. A couple of things are noticeable. Costs continue to go up. But because the gold price has increased so much, a lot of companies now have more than $1,000 per ounce all-in sustaining cost margin. So costs are going up, but companies are making more than enough money to cover that. But one thing that's noticeable, companies are not increasing their dividends. They're not sharing that bonanza with their shareholders. A number of companies have announced share buyback programs or extensions of share buyback programs. I would argue that's a bit of a sleight of hand, because that's not really returns to shareholders, because it rewards shareholders for leaving, not for staying with you. What are you seeing in the data there?
Well, I've been here, unfortunately, haven't been able to see all the latest ones, but the dividends in the mining industry have traditionally been lower than you can see in other industries. That's absolutely true. And that does make it a difficult case if you want a long-term shareholder for the value. Would they be better served going to the banking industry versus the mining industry? And traditionally, that's been the case. Hopefully, with gold prices being so high, some of those companies will reward their loyal shareholders. So we'll see if that changes.
Is there something that the mining sector or mining company executives are not getting right or not understanding about investors? Everybody says they want to attract the generalist investors. I would posit that generalist investors look at the mining sector alongside other sectors, and as you mentioned, other sectors give better yield or better returns to shareholders, so why bother?
It's a challenge all around, I think, for the mining industry. There's a lot of competition. Crypto, which was something that didn't exist, a decade or two ago, but it's so much easier now to just buy gold. If you're interested in investing in gold, you can buy gold on your laptop in 5 minutes.
On Kitco.com, of course. Yeah.
There you go. Unintentional plug, but yeah, it's very easy to do. And then you don't have to worry about company management. You're just invested in the commodity if you believe the commodity is going to do well. So it is very challenging, and I would say that I do think that the industry in general has to get a little bit more creative in how they show the value to not just an industry expert, but to people who don't know mining at all. We need to do better to advocate for ourselves to investors. It's not something you see a lot.
Absolutely. Now, let's end with a forward-looking statement, if I may, Kevin. We are at an investing event, and the adage is that the trend is your friend. So what trends can investors look to, or should they look out for as 2025 continues?
I would say probably continued volatility, especially around the markets for mining. So fundraising, we expect the financing market to continue to be a struggle for the junior sector. Some of the commodities that are doing very well right now, gold, we expect it to continue doing very well. And those that are not doing so well, like nickel, we expect to continue to not do well. So it's going to be sort of a continuation. A lot of the major themes that we ended 2024 with are continuing. So it's going to be a kind of similar year. If we were going to do a wild prediction, we'd make a fairly unwild prediction and say we saw 2024. I think we're expecting pretty much something similar to that.
So exciting times, but not quite exciting times. It does seem quite odd that gold's at 2,900, let's say $50 per ounce, and nobody really seems to be really excited.
It is very, very strange, but that just sort of speaks to the malaise over the mining industry in general. Not really. Gold is just sort of a victim of it at this point, where people just aren't interested in the mining industry like we were hoping they would be. We got a little bit of cool when we were being tweeted about by very important people a few years ago, and that's gone now. We no longer have anybody saying, hey, we need to be worried about mining anymore. It's sort of faded away. So we've lost a little bit of that exposure, and with that, we've lost a lot of interest.
I mean, is that a situation that will just last until that sort of $2,950 per ounce number goes higher?
Possibly. That's always the potential that at some point there's going to be a major move. Somebody is going to start investing. And success breeds success, of course. And the moment one stock breaks through, it could have a rolling effect for, at this point we're going to say for gold, because that's the commodity that really should have a breakout at some point. So, but we haven't seen that yet, which is a little bit puzzling, isn't it? When gold is, and it's not a new phenomenon, gold has been over 2,000 an ounce for quite some time, so it's a little bit strange.
Well, hopefully that moment will come in the not too distant future.
We definitely hope so, yeah.
Well, Kevin, it's been wonderful. Thank you very much for your insights. Thank you very much for joining us today.
Oh, thank you.
And we have a lot more to come from the 2025 Mines and Money Conference here in Miami, in Florida. So hit that subscribe button. I'm Paul Harris, and this is Kitco Mining.
Kitco Mining's special coverage of Mines and Money in Miami, Florida is brought to you by Gold Shore.